Picture this. It's 1347. A Venetian merchant stands at the edge of the Grand Canal, watching his ship disappear into the morning mist. That vessel carries his entire fortune: silk from Constantinople, spices from Alexandria, precious dyes worth more than gold. One storm, one pirate attack, one miscalculation, and he could lose everything. But here's what's remarkable. He's not panicking, because Venice had invented something that would change commerce forever. Something we take for granted today, but in medieval times, it was nothing short of revolutionary. They invented the art of sharing risk. To understand why this mattered, you need to understand medieval trade. Venice in the 13th and 14th centuries wasn't just a city, it was the gateway between East and West. The Republic of Venice controlled the Mediterranean like no power before it. But maritime trade was incredibly dangerous. Studies of medieval shipping records show that roughly 1 in every 10 ships never made it home. Pirates prowled the Adriatic. Storms could sink a fleet in hours. Reefs, navigation errors, fires, spoiled cargo, the list of disasters was endless. And here's the cruel part. It took everything you had to finance a trading voyage. A single ship loaded with Eastern goods could cost as much as a palazzo. Most merchants couldn't afford to own a ship outright. Even wealthy families would be ruined by a single catastrophic loss. So Venice faced a paradox. They had access to the world's most profitable trade routes, but the risk of using them could destroy anyone who tried. The solution they developed would become the foundation of modern capitalism. The Venetians didn't invent insurance from scratch, but they perfected it. By the early 1300s, they had developed several ingenious systems for spreading risk. First, there was the collegantia, a partnership contract that split both investment and risk. A wealthy investor would provide capital. A traveling merchant would sail with the goods. If the voyage succeeded, they'd split the profits. If it failed, the investor bore most of the loss, but the merchant lost his time and effort. This was brilliant because it allowed widows, clergy, and nobles, people who couldn't travel, to invest in trade while giving ambitious merchants access to capital. But the real breakthrough came with marine insurance contracts. By the 1342, Venetian notaries were drawing up formal insurance policies. A merchant would pay a premium, usually 12 to 15% of the cargo's value. In return, insurers would guarantee to cover losses from shipwreck, piracy, or other disasters. These weren't casual handshake deals, they were detailed legal contracts, recorded by notaries, enforceable in Venice's commercial courts. The church had long condemned charging interest on loans as usury, but insurance was different. You weren't charging interest, you were accepting risk in exchange for a fee. This distinction changed everything. Let's walk through a real example. In 1385, a merchant named Marco Strozzi wanted to ship 400 ducats worth of cloth to Beirut. That's about $40,000 in today's money, a fortune. Strozzi couldn't afford to lose that much, so he went to an insurance broker near the Rialto Bridge. The broker assembled a group of investors, sometimes a dozen or more. Each agreed to cover a portion of the risk. One might insure 50 ducats worth, another 75. Strozzi paid his premium. The investors split it. If the ship arrived safely, the investors kept the premium as profit. If disaster struck, they'd cover the loss proportionally. This system did something remarkable. It transformed an unbearable risk into a manageable cost. Strozzi paid 15% up front, but he was guaranteed not to lose everything. The investors spread their exposure across dozens of voyages, so one disaster wouldn't ruin them. It was mathematical risk management, centuries before probability theory existed. And it worked because Venice had something crucial: trust and enforcement. The Republic's courts were known for being fair and swift. If an insurer refused to pay a legitimate claim, they'd face legal consequences and social ruin. In a city where reputation was everything, that mattered. Once Venetians proved insurance worked, the idea spread like wildfire. By 1400, insurance contracts were common in Genoa, Florence, Barcelona, and throughout the Mediterranean. But the impact went far beyond just protecting individual merchants. Insurance fundamentally changed what was possible in trade. Before insurance, merchants played it safe. They stuck to familiar routes. They carried diverse cargo to hedge their bets. They avoided the riskiest, most profitable ventures. After insurance, everything changed. Merchants could specialize. They could take bigger risks because those risks were shared. They could plan long-term investments knowing they wouldn't be wiped out by a single stroke of bad luck. This is why the age of exploration was possible. When Portuguese sailors rounded Africa, when Columbus sailed west, when Magellan circumnavigated the globe, all of these ventures required massive investment with uncertain returns. Insurance made the impossible calculable, and the implications went beyond trade. The same principles were applied to other risks: fire insurance, life insurance, crop insurance. The mathematical tools developed to price ship insurance eventually led to probability theory, statistics, and actuarial science. Venice's insurance contracts were the seeds of the modern financial system. Today, insurance is so embedded in our lives we barely notice it. We insure our cars, our homes, our health, our lives. Businesses insure against cyber attacks, weather disasters, and executive kidnapping. There's even insurance for insurance. It's called reinsurance. But at its heart, it's still the same principle those Venetian merchants discovered, that by pooling risk, we can all accomplish more than we could alone. Think about it. Every time you start a business, buy a house, or invest in the stock market, you're relying on the same mathematical insight. Risk doesn't disappear, but it can be measured, priced, and shared. The Venetians understood something profound. They realized that the biggest obstacle to prosperity wasn't lack of opportunity, it was the fear of catastrophic loss. By creating mechanisms to share that risk, they unleashed human ambition. So, the next time you pay an insurance premium and grumble about the cost, remember that Venetian merchant, standing at the canal in 1347, watching his ship sail away, he paid his premium too. But because of it, he could sleep at night. He could plan for the future. He could take the risks that would make him wealthy, and in doing so, build the interconnected world of trade we live in today. Venice didn't just build ships. They built the financial architecture that made global commerce possible. And it all started with a simple question: what if we didn't have to face our risks alone? If you enjoyed this story, and want to discover more hidden origins behind the systems that shaped our world, like trade, money, and innovation, make sure to subscribe and leave a like. Your support helps us bring history's most fascinating ideas to life.